Hi, I'm TaxMax. Let's break down today's tax topic.
Here's a strange UK tax fact. Corporation tax is not calculated once a year in a single step. Instead, it follows a mechanical process set out in tax law. In this episode, we explain how corporation tax is actually calculated in practice. Corporation tax is calculated for specific periods called chargeable accounting periods, often shortened to CAPs. In many cases, a chargeable accounting period matches the company's accounting period. However, tax law places a strict limit on how long a chargeable accounting period can be. A chargeable accounting period cannot be longer than 12 months. If a company prepares accounts covering more than 12 months, that period must be split. It becomes two separate chargeable accounting periods, and each one is taxed independently. Short chargeable accounting periods can also arise. This happens when a company starts trading, stops trading, or changes its accounting date. In every case, corporation tax is calculated separately for each chargeable accounting period. The calculation of corporation tax begins with accounting profit. This is the profit shown in the company's statutory accounts. However, accounting profit is not the figure that tax is charged on. That is because accounting rules and tax rules are not the same. To move from accounting profit to a tax figure, adjustments are made using tax law. Some costs shown in the accounts are not allowed for tax purposes, while other amounts may be allowed for tax even if they do not appear in the accounts. After all tax adjustments are made, the result is called taxable total profits, often shortened to TTP. Corporation tax is charged on taxable total profits. It is not charged on turnover and not directly on accounting profit. Different types of income are treated differently when allocating profits. Trading profits and UK property income are usually time apportioned on a daily basis. Chargeable gains are allocated by the date of disposal, while dividends and donations are allocated by their receipt or payment dates. Once taxable total profits have been calculated, the next step is applying the corporation tax rate. Corporation tax rates are set by reference to financial years, which run from the 1st of April to the following 31st of March. These financial years do not always align neatly with a company's accounting period. As at September 2025, two key thresholds apply: £50,000 and £250,000. Companies with lower profits may qualify for the small profits rate, while companies with higher profits pay the main rate. Where profits fall between those thresholds, marginal relief applies. Marginal relief reduces the effective rate of tax using a statutory formula. The size of a company's profits directly affects how the tax is calculated. Some companies cannot use the small profits rate or marginal relief. This includes close investment holding companies. These companies always pay corporation tax at the main rate, regardless of profit size. If a chargeable accounting period spans two financial years with different rates, profits are split. They are time apportioned between the financial years, and each portion is taxed using the rate that applies to that year. Putting it all together, the process follows a fixed structure. Identify the chargeable accounting period. Start with accounting profit and apply tax adjustments. Calculate taxable total profits, apply the correct rate and reliefs, and arrive at the corporation tax liability. This is how corporation tax is calculated in practice in the UK. Later episodes will build on this by looking at marginal relief in detail, filing returns, and HMRC powers, one step at a time.
Educational content only, not advice. Rules can change.